after many subscriber comments asking me to review other covered call ETFs like NVDY and CONY, I think it's finally time to settle a large question about these covered call ETFs. That question is, are you throwing away money investing in these covered call ETFs that have been on an absolute tear? I mean, like NVDY and CONY are way up, and you would have easily doubled your money with both of these in a few short months. Or would it have been better to buy the underlying asset and make monthly withdrawals instead? Which one of these methods allows more room for growth, and then which one gives you the bigger payments if you are an income investor? We will explore these questions in this video. But as usual, none of this is financial advice. Literally none of it. I'm not a financial advisor.
Knowledge.
Now, I'm assuming if you're watching this video, you know what NVDY is, you know what CONY is, you know what YieldMax is, the Defiance funds. So I'm not going to go over that in this video. So let's just start with NVDY and compare its performance to its underlying asset, NVIDIA. So I have NVIDIA up on screen here, guys, and I have a percentage based on the right, and you can see since inception in early May of 2023, it's been on 111% gain with dividends reinvested. In TradingView, you can see if dividends are reinvested when you click ADG. When you unclick it, you can see how it's adjusted for there, and it's up a 29% gain without dividends reinvested. So with a big difference. Now, if we overlay NVIDIA on the chart, it's no surprise in the same time period, NVIDIA has been outperforming NVDY. That's no surprise. This is a covered call fund ETF, assuming you want income, which limits the upside. So if you wanted growth, yes, NVIDIA definitely would have been the better pick within this time period. But I know that's not the reason you guys are investing in these. You want income for these covered call ETFs. So the question is, if I was actually going to use this for income, what would have been better? Owning NVIDIA and taking out the income, or using NVIDIA and then just withdrawing a certain amount per month? So let's answer that in Portfolio Visualizer. Let's assume we had a $10,000 initial capital amount, and let's do a withdraw fixed percentage. Now in Portfolio Visualizer, guys, you have to reinvest the dividends if you can do a withdrawal percentage amount. So just keep that in mind when I'm doing these results. But let's do something ridiculous with a withdrawal percentage per month. We can see the distribution rate for NVIDIA right now, time recording on 4/26/2024 is 124%, and its 30-day yield is about 4%. So let's say we take out 5% per month of NVIDIA and NVIDIA, and we're going to do this monthly. So we're getting paid monthly. We're taking out the money from the growth of NVIDIA and then taking out some of our dividends. What would this look like, and which one would have a better value? So Portfolio 1 is going to be 100% NVIDIA. Portfolio 2 is going to be 100% NVIDIA. And when we look at these results, we can see since inception, Portfolio 1 is NVIDIA, red is NVIDIA. We can see NVIDIA fares better if we just took out withdrawals per month. We're taking out 5% per month on NVIDIA, and it still fares better than with the covered calls on NVIDIA. And you can see this with the graph. It never touches down past NVIDIA, even with 5% per month withdrawal, which is 60% per year. You're paying yourself 60% per year with NVIDIA, and NVIDIA still fares better. I mean, you have almost $3,000 more dollars. And we see the best year for NVIDIA is 82%, even with the withdrawals. And the best year for NVIDIA is 54%. These are huge differences, and the return is 43% compared to 14%. So these are huge differences, guys. So with NVIDIA versus NVIDIA, it's obvious owning NVIDIA would have been better and just making monthly withdrawals if you want to do that instead. And you have to keep in mind, guys, the graph on TradingView is with dividends reinvested. With NVIDIA, it had a 200% price increase since NVIDIA came out, and NVIDIA only increased 30%. Okay? So if you had a 200% price increase for NVIDIA only increasing 30%, what does that say about that? These are on a downward trajectory like all other covered called ETFs, unless NVIDIA just keeps performing massively, which I don't think it will, but you never know, because, I mean, this is a ridiculous gain, guys, in a couple months. I mean, look at that, 80%, 100% in a couple months. So we can't discount that NVIDIA could just keep pumping. Now, you may say on TradingView, I might not be accounting for the drip. I'm not exactly sure how TradingView calculates the dividends, their adjusted dividend price. So let's also do that in Portfolio Visualizer. Let's keep everything the same, and I'm not doing cash flows anymore, and I'm reinvesting the dividends. Which one would fare better? Of course, NVIDIA is going to fare better. You can see I have 138% gain versus 91. And keep in mind, Portfolio Visualizer, this is from March 31st gains, and they're starting this on May 31st. So you are missing this last little bit, so results are going to be a little different. But it's obvious from this test, owning NVIDIA just would have been better than owning NVIDIA. What if we do COIN? What if we do CONY instead? What would that look like? When we look in CONY since inception, it is up 114%, which is huge. If we take off the dividends, it's up 23% since inception of early August 2023. So what happens when we overline coin-based stock over this, and we can see which one would have been better to own. We can see Coinbase has pumped 194%, and then CONY without dividends reinvested is only up 23%. So if something's not pumping, these stocks are not going to rise. When we adjust for the dividends, we can see COIN still outperforms CONY by a huge amount. I mean, this is a difference of 80%, 114 versus 194. So let's do the same test. Let's say we wanted to withdraw a fixed percentage. Again, we're going to do 5% per month. So let's compare what would have been better, just owning COIN or owning CONY during this time period since inception. When we scroll down, we can see we actually get different results versus the NVIDIA versus NVIDIA. If we're withdrawing 5% per month, owning CONY would actually be better than owning COIN because they do have the covered calls, so that does provide a little extra downside protection. But when COIN gets going again, you're going to be left in the dust. And we can see this with our return, 132%. When we're withdrawing 5% per month, you still get that gain versus 60%. So that would have been a 60% withdrawal percentage per year, and you would have had better results with COIN in the end. Now, yes, you can argue there was a period where CONY outperformed COIN. That is true, but my question is, are you really going to be buying COIN if you expect it to go downwards? Are you really trying to play that like that? And if you are, I mean, maybe you have some strategy I'm not aware of, but it doesn't make sense to be buying a losing stock for your income-based strategy. So in the end, owning COIN, making monthly withdrawals would have been better. And if we reinvested all these dividends, if we didn't have any withdrawn percentage and reinvested all the dividends, we can see we end with the same result, and we have a 233% gain versus 130% gain on CONY. So you are being left in the dust when you're buying CONY. So we can see in each of these cases, you would have fared better just owning the underlying asset if you needed income, and if you need to reinvest the dividend for most times. You would have just been better owning COIN or NVIDIA. I'm going to make a bold claim in this video right now, and I'll specifically talk about YieldMax and Defiance funds with crazy yields, not other covered called funds. The claim is you'll always be better off going for growth instead of investing in these type of dividend funds. You'll always be better going for growth. Why? Because if you need to reinvest all of your dividends and you're focusing on the drip, that means you don't have enough money to be financially free. If you need to reinvest the dividends, you do not have enough to be financially free at the moment. And I know that's true for most of these YouTubers because I see people doing with like $25,000. They're like, I'm going to retire soon. So if you don't have enough money to be financially free, that means you need more money. If you need more money, wouldn't you want the most growth possible? If you need growth to have more money to be financially free, why are you willingly investing in the worst performing asset when you're not going to use the dividends anyways? If we look at COIN versus CONY, you would have had a 2x instead of a 1x. I mean, still great gains, but it's a very different portfolio. If we look at NVIDIA, same thing. You would have had a 2x instead of a 1x. Very big different portfolios. Why are you choosing the worst performing asset if you need growth? Especially if you don't need the dividend. Because of the high dividend yield? The dividend yield is only high because the stock price goes up, and all the back tests have shown this in almost all periods. You would have just been better withdrawing from COIN or NVIDIA. If we look at Tesla, you can check out my old videos, you can see it performs terribly. All these perform worse than the underlying asset, so why are you investing in these funds? Do not get blinded by the dividend. Do not get blinded by this 124% distribution rate. It's making you all invest in silly things and just give these people your money. If you do not have money to live off dividends, this is my opinion, not financial advice, it makes more sense to invest in growth than willingly pick the slow road. You're picking the slow road, investing in these covered call ETFs that have a similar amount of risk. You are willingly picking the slow road by investing in these ETFs. Now, what if you are living off dividends? What if you're like, I'm actually living off all these funds? I honestly hope this isn't a major holding for you, because when NVIDIA normalizes, if you look at this drop right here, that was 20%. The fund drops at a similar rate. And this is what dividends reinvest right now, 20%. You have a lot of volatility in your dividend portfolio with a similar downside risk. So it doesn't make sense for a dividend portfolio for a consistent income portfolio. You're getting a crazy yield with the same downside risk because you're owning an incredibly pumping stock. So why wouldn't you just want to own the actual stock? If we look at other corrections, we can check out the new one, MISTY, which is the MicroStrategies Covered Call ETF. And let's put MicroStrategies up here. We can see this one is actually very similar because MicroStrategies had a giant dump. We can see that was a 33% correction. We get similar thing on MISTY. It's at about a 21% correction versus 33. But when we turn off dividends, it has a similar correction of 30%. So your downside risk is slightly less, but it's not that much if you're not reinvesting the dividend. So you're basically stuck reinvesting the dividend with the downside risk when you wanted income. So let me ask you this. If your goal is dividend investing, meaning you want consistent income month by month, does investing in things like MISTY really fit your goal? Things like CONY, things like NVDY. If you want consistent income, does having a dividend paying asset that fluctuates, what is this, 100%? 100% right there, and then drops what, 50%? 40%? Does this really make you financially free? Does seeing your portfolio fluctuate so much to the degree for an asset that underperforms this underlying asset? Does this really give you mental freedom? Does this give you freedom? Or is this just more anxiety when the dividend drops because your share price falls? Why are you willingly choosing the worst asset with the worst gains? I swear, like most of you YieldMax fanboys, the Defiance fanboys, you've honestly gone crazy for a dividend because none of these things make sense. So I'm begging you, please open your eyes. Analyze why you're actually investing in things like NVDY, CONY, MISTY, other covered call ETFs. Is it because you actually like MicroStrategies? Do you actually like Coinbase? Do you actually like NVIDIA? Or does the idea of putting a lot of your money into these stocks kind of repulse you? Do you own any of these stocks in your portfolio? Does that scare you? How much NVIDIA, Coinbase, MicroStrategy, Tesla, Microsoft, whatever, do you actually own? If the idea of owning a lot of these repulses you or scares you to own these stocks, that probably means you're blinded by this silly dividend, which performs worse. You don't actually like the underlying asset. And it tracks similar to the underlying asset. So please really analyze and look at what you're doing, because you're losing money and getting worse performance. If you're still not convinced these covered call ETFs are a bad idea, look at this video right here where I go over Tesla and QYLD and really put the nail in the coffin for you guys. Peace.